Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. After increasing early in the week, the yield on the benchmark 10-year U.S. Treasury note fell back on Friday following the May payout report. The broad municipal bond market outperformed treasuries over much of the week, and our muni traders reported improvement in secondary market trading volumes as the week progressed. According to the latest data from Lipper, municipal bond fund industry-wide received net inflows of nearly USD 1 billion for the week ended June 2nd, including strong flows into tax-exempt high-yield portfolios. The corporate bond market was relatively quiet. The high-yield market was fairly subdued, although traders reported that news of progress in negotiations over a new infrastructure bill appeared to support negotiations over a new infrastructure bill appeared to be support sentiment, and outflows from below investment-grade funds subsided. The strength of the economic recovery remained in the spotlight, with Friday bringing the closely watched monthly non-farm payrolls report. The Labor Department reported that employers added 559,000 jobs in May, somewhat below consensus forecast of around 650,000. The labor force participation rate ticked down to 61.6% from 61.7%. On the positive side, however, the employment to population ratio, considered by some to be more important to Fed officials, ticked higher, and the unemployment rate fell more than expected, from 6.1% to 5.8%. Average hourly earnings increased 0.5% above consensus and indicative of a tighter labor market. Although the report offered mixed signals, stocks rose and longer-term bond yields decreased on the news, suggesting that most investors expected it would give the Federal Reserve additional time to keep monetary policy highly accommodative. On Tuesday, Fed Governor Lael Brainard and Vice Chair Randal Corliss both stressed the significant slack remained in the economy and that the Fed was far from achieving its inflation and employment targets. They both stressed, however, that the Fed would be quick to act if the recent increase in inflation does not prove to be transitory. Much of the rest of the week's economic data came in above consensus. Payroll processing firm ADP reported that its tally of private sector jobs increased by 978,000 in May, well above consensus expectation for a gain of 650,000. Restaurants and other leisure and hospitality businesses were responsible for 440,000 of the new hires, and IHS Markit's gauge of service sector activity reached its highest level in records, going back to 2009. Manufacturing signals generally remained strong, although construction spending grew less than expected, and construction employment surprised many by contradicting a Bay of May. The major indexes closed moderately higher in a shortened trading week, with markets closed Monday in observance of Memorial Day. Energy shares performed their best within the S&P 500 index as oil prices reached their highest in 2 years. Trading volumes were generally light, as is typical of the start of the summer holiday season. T.Rowe price traders noted that volumes would have been lighter if not for concentrated buying and selling by retail investors of what some have termed meme stocks, which are smaller cap, consumer-oriented shares actively discussed on social media. Shares of theaters chain AMC experienced particularly heavy trading and volatility. Anyways, that pretty much wraps up the news for this week. Now I'm going to hand it on to Om to discuss our financial term.
A unicorn is a savvy venture capital term for any startup company that has a valuation of over $1 billion. In short, venture capital is a process whereby investors with a lot of money can invest in entrepreneurs who have ideas but do not have the money. Venture capitalist Eileen Lee, a founder of Cowboy VC, coined this term. Some popular examples include Airbnb, SpaceX, and even the brokers we know and love, Robinhood. Eileen first used the term unicorn in her article, Welcome to the Unicorn Club, Learning from Billion-Dollar Startups. In this article, she compares how rare finding billion-dollar startups are to finding a unicorn, thus coining the term. After Lee's article, this term has become widely used for companies in the technology sector, as most of these companies have extremely high valuations compared to their finances and their balance sheets. It has become a FOMO, where investors don't want to miss out on the next Facebook or Google. So they abandon any form of traditional risk analysis and look for these type of shareholding opportunities. People still debate whether or not this kind of behavior from institutional investors can lead to a repeat of the dot-com bubble from the 90s. Some like John Mullins, who wrote the book The Customer Funded Business, argue that the increase of the number of companies with a valuation of over $1 billion is a clear sign of fraud in the markets. Others argue that a large number of technology companies with extremely high valuations is a sign of a new wave of technologically driven productivity, similar to the invention of the printing press nearly 600 years ago. Most of the time, the valuations for these companies are based on their future potential, which is what makes them such a risky investment. In essence, their valuations have nothing to do with their current financial performance, which is why most institutional investors don't use the tactics of fundamental analysis or balance sheet analysis to value these shares. Furthermore, sometimes these companies are truly groundbreaking and don't have any competitors in their respective fields, or they don't have any similar business models to compare to, so institutional investors are left without a clue.